We're going to tell the wealthiest people in this country that they are going to start paying their fair share of taxes.
Wealth taxes are in the news these days.
We need to put a tax on the top 1/10 of 1%, the biggest fortunes in this country.
Supporters see a wealth tax as a way to reduce inequality and reduce the political power of the very wealthy. Opponents claim that a wealth tax would face serious challenges. But what exactly is a wealth tax? And would it work for America? First, let's talk about what a wealth tax is and what it isn't. It's important to recognize that a wealth tax is not the same thing as an income tax. Instead of being taxed on things like wages and interest, a wealth tax would apply to assets that are owned minus debts that are owed. As you probably guessed, the wealth tax would only apply to the very wealthy. In the November 2019 version of her plan, Elizabeth Warren proposed a tax of 2% per year on wealth over $50 million and 6% per year on wealth in excess of $1 billion. Bernie Sanders' plan begins with a rate of 1% per year for wealth above $32 million and reaches 8% per year for wealth above $10 billion. Now these numbers might seem low, but remember that the same stock of wealth is taxed each year, and that adds up over time. Let's put this in terms of income tax rates. Imagine a taxpayer who holds a bond with a fixed interest rate of 3% per year. A 6% per year wealth tax is equivalent to a 200% income tax, because the tax is double the taxpayer's interest income. And don't forget that a wealth tax would be in addition to the income tax. Now that we have a basic understanding of what a wealth tax is, let's try to predict what would happen if America decided to adopt it. First, lobbyists would likely fight for special tax breaks, exempting certain kinds of assets from the tax. Asset exemptions would not only reduce the tax's revenue yield, but they would encourage wealthy taxpayers to shift their wealth to the exempt assets. We've seen that pattern occur in France and Germany, who have since repealed their wealth taxes. Next, taxpayers and the IRS would have the burden of figuring out what certain assets are worth. Now that's easy for bank accounts or stocks, but it's far more complicated for many other things. How much would you say this house is worth? This business? This yacht? Another possible side effect of a wealth tax is the impact on businesses and workers. Reducing the savings of the richest Americans reduces the funds available for business investments in factories, equipment, and research. With less investment, workers would be less productive and would earn lower wages. So workers could actually end up bearing a small part of the wealth tax burden. To top things off, the wealth tax might be struck down as unconstitutional. The Constitution requires that direct federal taxes, other than income taxes, be divided among the states in proportion to their population. Dividing the wealth tax in that way would probably not be doable. Some legal scholars argue that the wealth tax is not subject to this requirement because it's an indirect tax. But others disagree. Nobody knows how the courts would rule. With a poor track record in Europe, the potential for special tax breaks, administrative challenges, and the risk of being struck down as unconstitutional, a wealth tax may not be the best strategy for taxing the rich. It might make more sense to use other policies, such as reforms to the income tax and the estate and gift taxes. But until then, we'll just have to ask ourselves, what if? To learn more about wealth taxes, check out the link in the description below. Also, let us know what other topics you'd like AEI scholars to cover on What If. And be sure to subscribe for more videos and research from AEI.